Testing one, testing one. Okay, well, good evening, everyone. Thank you for joining us tonight. We're going to be going into Chapter 5 and discussing Chapter 5 and the different inventory methods, such as FIFO, LIFO, weighted cost average, and specific identification. Now, some of this is going to be a refresher. So I know I'm probably going to get an email saying, Professor Schaefer, I went and watched your video tonight that you had up on YouTube, and notice I'm not accusing y'all of this. And apparently you reposted last week's video. Well, there is some stuff that bears repeating, and that's why it's going to at first seem like we're looking at Chapter 4, but we're just reviewing some things that I consider to be important. So when we're determining what gets inventory, this is a good definition. Includes all goods that a company owns and holds for sale, regardless of where the goods are located and when the inventory is counted. So, if it's FOB shipping, all right, and it's coming, shipping point rather, I should say, and it's coming, you've got to include that with your inventory when you do your inventory before doing your adjusted entries. We're going to talk about consignments in a minute. And we also have to account for goods that are damaged or obsolete, even though we don't intend to sell them. Okay. And we're going to look at what we do if we have that. In fact, I think we looked at it last week where if we have something that's returned and we can't reuse it, we really don't put it back into inventory. We actually expense it as damaged goods. But we'll hopefully discuss it for the end of the hour. So we have FOB shipping point. That means it gets included in the buyer's inventory, like I said. And FOB destination, it's going to go into the seller's inventory until it arrives at your loading dock. Okay, just that simple. Just good point of reference here is shipping point means you own the goods. Destination means they own the goods. So let's talk about consignments. A lot of people will put their goods into other people's stores for sale, but they won't sell it to the store. Instead of selling it to the store, they will leave it with the store for them to sell it, and then they'll come back periodically. They'll count what was left on the display, restock it, and then give a bill to the store owner for them to pay what was sold off their rack. Okay. You may have gone into a convenience store and noticed that there is a rack full of headphones and phone chargers and those kind of things. Those are the kind of things that typically would be sold on consignment. There's another way. You probably have seen consignment shops. There's a big one in Malden next to Tractor Supply where people take their stuff there. They leave it with the owner. I'm sure the owner has record keeping to identify everything that's left for him in the store. And then the owner can come back periodically and check and see if their stuff was sold. And what happens is the store owner will keep a percentage for themselves and give the balance to the person who owns the goods. If you travel around the mountains, we have a lot of people that do crafts that sell them in the country stores. More often than not, those items are being sold on consignment. In other words, they bring their crafts to the store owner. He puts them out on display. And after they're sold, he or she will take a cut, and then it will, after they take a cut, then that person will restock the shelves. So that's selling on consignments. The goods that are on consignment will not be inventory by the person putting them out on display that owns the store. The person that left the goods with the store owner puts them in their inventory. And that's important, all right? Because let's say you're doing your inventory at the end of the year and you've got goods out there on consignment, you're really going to need to go out as close to the end of the year as possible and count all those goods and make sure that they get included with your inventory. And you might think, well, that's a pain. Well, the IRS wants accurate record keeping when you're doing inventory. They want, when you file a tax return, you're signing your name that everything on there is true and correct. And if you get audited later and find out that you cut corners, you might not have to pay. Well, you will have to pay penalties probably if they assess more tax. They're not going to lock you up, but who wants to go through an audit with an auditor you've already made mad because you were just not conscientious enough to do your inventory correctly? And they do take offense to stuff like that. So, this is why if you're a consignor as the owner of goods, you got to make sure you include it all in your inventory. Next, we have how do we handle damaged or obsolete goods? I mean, you're going to get returns that you're not going to be able to resell to customers. So you don't report them in inventory or carry them in inventory if they're not going to be resold. What you have to do is these will be debited to an expense category, which is damaged goods. You're going to do a credit to cost of goods sold, then you're going to do a debit to damaged goods expenses, essentially. Some put it up next to cost of goods sold, or up in the net sales area. But really, most of my clients, they'll have an expense down in the operating expense area to where they'll put their damaged goods. There's something called net realizable value, and that's the sales price minus the selling cost. That's important to know. And you're going to have a loss whenever there's damage or obsolescence occurs. If there's something you can't put out there because it's obsolete. Another example would be too, you've heard about these recalls where, meat's gone bad or cans have been damaged and you have to take the stuff back to the grocery stores. Well, grocery stores just going to throw it out. They're not going to send it back to the manufacturer, but they're going to report to the manufacturer that this occurred. And that's when you're going to treat it the same way as damaged goods. Now, in determining inventory costs, you have to include all costs that get that item ready for sale. Let me give you an example. Let's say you own a bike shop. And so when your bicycles come in, they probably are disassembled. So you have to have an employee put them together, and maybe they're bare bones. So you have to put a seat on them. You have to put a bell on them. You got to put a light on them and all those extra things they didn't come with. They get all included with inventory costs. If you pay for shipping to have them shipped to you, which is FOB shipping point, that gets included with the cost that's going to be added into your inventory. Storage. You probably have heard that there was a lot of storage issues with these ships that were part of the supply crisis, I guess you'd call it. That those storage costs get added into the cost of goods. That may be, well, I know that's part of why inflation's being fueled right now, because we're paying for a lot of stuff that sat in storage because they couldn't get enough trucks to pick it up at the pier. Insurance. Nobody does anything in business without carrying insurance because, theft's a problem. Acts of God are a problem. I remember I was driving down the interstate when I was working for the IRS in Oklahoma, and I actually watched a tractor trailer go off a bridge. And I'm thinking to myself, well, not only was I concerned about the driver, of course, but, I was thinking about all of whatever was in the trailer. I hope it was insured because, and you probably have seen like a FedEx truck get into a really serious accident. On 85 has its share of tractor trailer accidents. And, if it wasn't for insurance, those companies would take a beating that own the goods inside those trucks. And then you have import duties. I have a client actually imports from Japan, and we have to add the import duties into their merchandise inventory as well. Now, I think I touched on this in chapter 4, but this bears worth repeating, is you've got to have internal controls when it comes to inventory. And if I've told you my Hibbett Sports story, I apologize, but I'm going to tell you again. My son used to run the Hibbett Sports in Cherrydale. Him and his manager were walking through the store on his first day taking over the store, and they had to do inventory. And when I got to the stock room, the district manager started hitting their finger on the side of the shoe boxes that were up on the shelf, and lo and behold, 50 of them were empty. Now if she hadn't done that, they would have counted inventory that did not exist. So that's why you have, internal controls when you're taking inventory. One of the controls they were exercising that day was 2 people were taking inventory. You've probably gone into Walmart or Target and you got people sitting there taking inventory of what's on the shelf with those big oversized calculators. Those people don't work for Walmart or Target. They are hired as a third-party company to take inventory, because you don't want your employees counting what they may and give them the opportunity to manipulate and cover up either their errors or their theft. You see most companies take a physical count of their inventory each year, but I think Walmart does it twice a year. I might be wrong on that, but I'm pretty sure they take it twice a year. So a lot of companies will take it either 4 times a year, twice a year, and do better than just the once a year. Why do you take a physical inventory if you're in a perpetual system that captures everything as it's sold? Well, you have theft and you have damage and breakage. You might have, I don't know, things may have occurred to where you thought you've accounted for the merchandise and taken them off inventory and you haven't. So this is the reason why you want to do the inventory and do it religiously and do it at the same time each year. And we're going to look at shrinkage. Well, we looked at shrinkage last week, but we might look at it again before the end of the night. I can't remember if it's discussed again in 5, because there's so many things we talked about last week that are reaffirmed here. So you can see that pre-numbered inventory tickets are used. Counters have no inventory responsibility because they're an outside company. Counters confirm the existence, amount, and the condition of inventory. That's important. You don't want to have out-of-date goods on the shelf, because theoretically they're obsolete, as we just talked about in the last slide, so they can't be in inventory or sold. And if there's a second count taken, it's usually done by a different counter. And manager confirming all items counted only once. So these are just examples of some of the controls. Companies probably have other controls. They probably don't publicize it if they have other controls, simply because they don't want to give anybody the opportunity to steal. So we're going to look at 4 different inventory methods. The first one's specific identification. Next one's first in, first out, then last in, first out, and then weighted average. Now, in specific identification, what would be an example of that? Well, a car dealer. When a car is sold, the salesman has a folder that shows exactly what the VIN number is and what it cost the company. So you're going to remove that item from inventory at that point. Okay. It's very similar to a perpetual inventory, although in a perpetual inventory, you're not actually specifically identifying each and every can of green beans going through. You just have a number of green beans that are in your system, and one has been sold and is then taken out of the inventory in the perpetual system. First in, first out. That means the oldest stuff goes out the door first. picture going into a restaurant and let's say they took LIFO literally, which is the next one, last in, first out. And so, you're good to go if you got a hamburger on a Monday, Tuesday, or Wednesday. Um, the lettuce is fresh if that's what they did. But think about getting it on a Friday or Saturday. You're gonna, if they use how they cost inventory in the same way they handle their inventory, then you're looking you're looking at wilted lettuce on your hamburger because it's already a week old. Believe it or not, last in, first out is popular with some companies, and we'll talk about that when we get into that particular one. And weighted average, you're essentially recalculating the items you have in inventory every time you bring some in and buy them, or when you go and sell them. Okay. And weighted average is mostly associated with large quantities of goods. Probably the best example would be a wholesaler. They're not going to send one washing machine at a time to their dealers. They're going to send out 3 or 4. So every time those 3 or 4 come in, they're going to, if they're using weighted cost average, that's when they adjust their prices. Now, I'm going to give you a word of caution before we get into these. There's going to be calculations involved in table format. Make sure that you do the transactions in order. I can't tell you, it's going to happen probably half a dozen times with the number of students I have this semester, that at least a half dozen students are going to do the table out of order. And you're thinking, well, how can that be? You've got the tables laid out for us. You've got instructions that are specific in the textbook that say how we're to calculate cost of goods sold under FIFO and LIFO. But I guarantee you that they're instead of taking it one step at a time, especially in weighted average, where it's really most important, that people will not, they'll be impatient and they're going to skip ahead, and then they're going to wonder why they got that particular homework problem wrong or test problem wrong. Exhibit 5.2 in your textbooks gives really a good illustration of FIFO, LIFO, and weighted average. And it, to keep FIFO straight from LIFO, just again, picture what if you're in a restaurant, and you want to use up the oldest stuff first. Okay. The stuff that came in first. And that's how you're going to account for the inventory costs the same way. LIFO is just the complete opposite. You're going to always carry your inventory at the last price you paid. Whereas FIFO, you're carrying your inventory at the first price you paid. All right. So first in, first out, first price you paid. Last in, first out, last price you paid. That's how you keep this straight. And then weighted average, again, you're going to recalculate it every time you get in a shipment or you make a sale. Again, we were introduced to this last chapter. How do we calculate merchandise available for sale? This is going to be more important in doing the calculations this week. We really didn't touch this in chapter 4, but now we're going to touch it each time we do one of the different inventory methods, because we have to constantly recalculate for merchandise available for sale. Last chapter, all we worried about was cost of goods sold. We're going to still worry about cost of goods sold, but we're also going to worry about merchandise available for sale. We're going to keep track of that in each of these 3 different inventory methods. Okay, again, refresher. Ending inventory is a balance sheet item. Cost of goods sold is an income statement item. We have to reset the cost of goods sold at the end of every accounting period. That means adjusting entries. But the balance sheet, that's something we got to carry our inventory over to the next period, because knowing what beginning inventory is important in order to be able to calculate an accurate adjusting entry when we close out the period. Take note of this box. Physical flow does not need to follow cost flow. Okay. you know, and this is an oversimplification, but product can be pulled off the shelf and sold to a customer out of order from which it came in. Okay, probably happens all the time with companies like Granger and that sort of thing. So that if that happens, that really doesn't it really doesn't impact FIFO, LIFO, or weighted cost average, because we're still going to account for the inventory the same. Inventory costing in a perpetual system. This is essentially, this is the format, by the way, that we're going to use in all 4 examples as we go through them. Same amount of purchases, same cost per unit. All right. We're not going to be changing it up as far as transaction goes. So what you see here, we're going to do for all 4 methods. In fact, I think this is specific identification. So you can see on August 1st, we had a beginning inventory. That's a balance sheet item of 10 units at $91 equal $910. So on August 1st, the beginning of the month, we have 10 units in inventory. And then on August 3rd, we got 15 units in at $106. We now have $1,590. That's what our acquisition cost is. Now we're up to 25 units. Next, in sales, we show that we sold 20 units at $130. Now that's the quantity of the units sold. All right. If you notice, we have down at the bottom now, we have the number of units available for sale and the cost of the goods available for sale. And then I'm going to skip ahead to the end of the month. You can see after all the transactions of purchasing and then selling, that we started off with 10 and we brought in how many units? Let's see, 55. So 55 units were acquired. Our ending inventory was, let's see, 43 units. I'm sorry, the units sold were 43 units. So we have 12 units left. Okay. All right, under specific identification, let's look at the transactions. I was wrong. I thought that last chart was, but it's really not. So on August 1st, we have 10 units at $91. That's our beginning inventory. August 3rd, we got in 15 units at 106 for $1,590. And so now we have 15 units at 106. Now, if we were to do what our ending inventory was with specific identification, ending inventory would be $2,500. Okay. But they were not shown an ending inventory balance in this example. August 17th. Oh, I'm sorry. Let me back up. Cost of goods sold under specific identification is we're making the assumption that the units were sold at specifically at 10 at $91. So you can see cost of goods sold is $910. Now, what we're going to do is we're going to track goods available for sale in these charts. Then we're going to track cost of goods sold. And then we're going to track the ending inventory based on what we count at the end of the period. And here it shows we had 5 bikes left at $115 and 7 at $119. And that's given us our ending inventory. I don't think you're going to get a specific identification problem. If you do, I think it'll only be like for half the month. So if any part of this trips you up, send me an email and I'll do my best to work you through it. Again, first in, first out, we're going to record costs that are oldest in cost of goods sold, and ending inventory is going to get the most recent costs. Now, why does it matter whether you do FIFO, LIFO, or weighted average? Well, we're going to see what the differences are. And we're going to see what the good and the bad is of every method. Again, this is a choice. that a company gets to make. There are no hard, fast rules unless you want to do LIFO, and I'll get into that specific rule later on. But under this, it essentially, by recording ending inventory and which are reflecting the most recent cost, in my mind, you're actually showing what you have left on the shelf. Okay. But that's personal. We'll get into the industry part in a minute. Okay, so under FIFO, let's look at this table. August 1st, you have a beginning balance of 10, and I'm going to call these bikes because back when these slides came out 9 years ago, that's what these are supposed to be examples of, bicycles. So we bought 10 bikes at $91 for $910. Then we went and purchased 15 more at $106. Now, we have to account for the differences here in what we paid for the individual bicycles. So when we do the inventory balance column, we're going to show 10 at 91 and then 15 at 106. And so the ending inventory balance will be $2,500. On August 14th, we had a sale. We sold 20 bikes. Now we have 25 bikes in inventory. So we got to figure out what costs are going to get assigned to the sale and we're going to record this as cost of goods sold because we're looking now at the cost of goods sold column when we're going to analyze this transaction. So we first in, first out. First in was 10 bikes at 91. So that's going to, we're going to record $910 cost of goods sale. Then we're going to take 10 bikes at the second purchase, okay, which came in later at 106. And that's going to give us cost of goods sold on August 14th of 1970. Now, what do we have left? Well, we have 5 bikes at $106. We're under FIFO. We record cost of goods sold first in, first out. And then whatever's remaining from that gets thrown in the inventory balance. You'll see the difference in a minute when we do LIFO. All right. Next, we purchased 20 bikes at 115. So now we have to change our inventory balance to we have 5 bikes at 106. We have 20 bikes at 115. So our inventory balance is $2,830. 28th, we buy 10 more bikes at $119. So that gives us, we purchased $1,190. So now we have 5 bikes at 106, 20 bikes at 115, 10 bikes at 119 for a total of $4,020. On August 30th, we sell 23 bikes. How are we going to record this? Well, we record cost of goods sold. We're going to show that we sold the 5 that we have left at $106. So that'll be $530. Remember, first in, first out. So here it's easy. You can just go by the prices. Next, we had 20 bikes at 115. We sold 18 of those, which means we have 2 left. And then, so when you combine these two together, we have cost of goods sold, and this transaction is going to be $2,600. Now, when we go over to the ending inventory balance, we look and we see that we have 2 bikes left at 115. We have 10 bikes, which is the entire August 28th purchase left at $119. So our ending inventory balance is $1,420. If we look at the bottom of the cost of goods sold column, we see that we have a cost of goods sold for the period of $4,570. If you combine what we recorded for August 14th and August 30th, combine those two things, and it comes up with $4,570. Very important that you do this in order. All right. Take it one date at a time. That way you keep everything straight. And I'll open up McGraw-Hill before we end here so you can see what the problems are going to look like. All right, next we have LIFO, which is last in, first out. So the most recent costs are going to go into cost of goods sold, and the oldest costs are going to be use for ending inventory. I mean, it's quite possible that you may have bought something in February and you're still carrying that cost in September as part of ending inventory. It's not unusual. I don't like LIFO because I don't think it's accurate when you do that. But again, that's personal. We'll get to what the differences are that you need to study for your test. So looking at the LIFO chart, we have the same thing, beginning balance, 10 bikes at $91 for $910. By the way, if I remember right, when you have these three tables you got to put together back to back, I think they keep the same transactions for each one, which I think makes it a little bit easier. Now, on August 3rd, you bought 15 bikes at 106. Your inventory is the same as we saw under FIFO, isn't it? Because we haven't sold anything yet. But here's where it gets different. On August 14th, we sold 20 bikes. So under LIFO, you have to go to the most recent purchase and eliminate and put them into cost of goods sold first. Most recent purchase was 15 at 106. Then we'll go back to the 10 we had at 91. And that's going to make our cost of goods sold $2,045, which is different than what we did under LIFO. Now our ending inventory is not 5 bikes at 106. It's 5 bikes at $91. And so we're going to carry that forward in inventory until our next sale. On August 17th, we bought 20 bikes at 115 again. And on August 28th, 10 and 119. So let's look at August 28th, where we have 5 bikes at 91, 20 at 115, 10 at 119 for a total of 39.45. Now, if you recall, I believe that was 4,000 and some dollars that was the ending inventory under FIFO. I can't remember the odd dollars, but it was over 4,000. So you can see already it's going to, whatever method you pick is going to affect what the amount you carry in inventory. Now on August 30th, we sold 23 bikes. Where do we go for the first set of bikes that are sold? We go to the last ones in, which were 10 at 119. So we're going to put that into cost of goods sold. Next, we're going to go back to the August 17th purchase. We're going to take 13 of those bikes at 115. And so our cost of goods sold for this transaction is $2,685. Now, if you've been kind of paying attention and comparing to FIFO, our cost of goods sold is going to be higher because what we're showing sold are the higher priced bicycles that we brought in under the LIFO method. Let's look at our ending inventory. Ending inventory is 5 bikes at 91 and 7 bikes at 115. So that's going to give us an ending inventory of 1,260. Let's go back and see what our ending inventory was under FIFO, 1,420. So we're carrying a lower ending inventory balance. So that's LIFO and FIFO. Now, under weighted cost average, we have to recalculate the average cost of inventory goods. So we're not going to specifically associate a cost with a date of purchase. The cost is going to be recalculated every time we buy stuff from the supplier, and every time we sell something to our customer. It all gets reevaluated each time. So this is going to be a little bit more lengthy. On August 14th, 20 bikes were sold. To determine the cost of units sold, we first need to compute the weighted cost average of what's in inventory. Now, if we look at August 1st, we start off the same, 10 bikes at $91, no change there. Then on August 3rd, we buy 15 bikes at 106. So we have to multiply the 10 bikes at 91 times 91, and then 15 bikes at 106, and add those together, and it comes to $2,500. Next, we have to divide that amount of money by the total number of bikes in inventory. And now the cost per unit for all units is $100. Let me repeat that, for all units. So on August 14th, we're going to multiply the 20 bikes we sold times $100. And that means our cost of goods sold is going to be $2,000. Then what we have left in inventory is 5 bikes. So we're going to multiply 5 times 100 because we're carrying, at this point, we're carrying the bikes at $100 per unit. And that means our ending inventory is $500. Okay. Now, let's go back and see what we had in inventory on August 14th. Under LIFO, it was $455. Under FIFO, it was $530. So weighted cost average is putting us in between LIFO and FIFO. Okay. You could argue that that makes this a more accurate method just because it's kind of like finding the median between, between the other two methods. Excuse me. All right. Next transaction. All right. After selling the 20 bikes, we bring in another 20 bikes at 115. No different than the other problems. All right. So we got to recalculate again. We're going to take the 5 bikes left at 100, the 20 bikes at 115, multiply them out, add them together, and that gives us $2,800. We have 25 units now on August 17th on hand. So we're going to divide it by 25, and that's going to give us $112 per unit. So you can see, bringing in the higher priced bikes, it kicked up the average cost per unit. Next, on August 28th, we brought in 10 bikes at 119. So we had, on August 17th, 25 bikes at 112. We're going to multiply that out. Then we bring in 10 bikes at 119, multiply that out, add the two together, divide it by 35, and we get $114 per unit. Definitely suggest, make sure you tag this in your book. So if you have to go back to refer to it in homework, you can go right to it. Okay. So now, after August 28th is over, we've got 35 bikes at $114 per unit. If I recall, we're going to sell 23 bikes in a couple days, right? Yep, August 30th, 23 bikes. And what we're going to do is we're going to use $114 per unit in calculating cost of goods sold. That means it's going to come to $2,622. Our ending inventory is going to be 12 bikes at 114. And so that's going to make our ending inventory $1,368. And this is what it looks like all combined, all the prior slides put together. Let's see, I'm going to jump ahead here. All right. So if we look at the 4 different methods, all right, under specific identification, cost of goods sold was $45.82. Under FIFO, it was $45.70. That's pretty close to specific identification. Although weighted averages too. Under LIFO, cost of goods sold is $47.30. All right. And then weighted average is going to produce cost of goods sold of $46.22. Again, this is in between FIFO and LIFO. Now, because I'm a tax person, first thing this tells me is if your cost of goods sold is higher under LIFO, you're going to end up having less profit. Because if you think about this, cost of goods sold is going to be a subtraction from sales. And so your gross profit's going to be less, probably your profit's going to be less. And so you're going to pay less taxes. Bingo. That's why people want LIFO. They want to pay less taxes. The problem is over time, it does even itself out. Okay. But so you're only doing that as a one-time thing. Now, the IRS does not like you switching back and forth between FIFO and LIFO. In fact, they make you send in a form called change of accounting method and get approval from the IRS before you do it. There's another rule that they have for LIFO, and this you probably need to know for your quiz or homework, is if you use LIFO for IRS purposes, you also have to use LIFO in your account, in your financial reporting. In other words, your books, which you don't, which isn't the case with weighted average and FIFO. All right. So, theoretically, you could use weighted average for books and then switch it over to FIFO for taxes. But that's really getting into the heavy stuff too early. You just need to know that if you're going to use LIFO, you got to use it for your books and for IRS reporting together. Let's go back to a side. So if you have first in, first out, ending inventory approximates what your current cost is. In other words, what your product costing you. All right. That's why I like it, because to me, it's a more accurate inventory. Last in, first out affects your cost of goods sold, as I just explained to you. All right. And it does approximate what that particular category of products is costing you. And then weighted average, it just keeps the price changes smoothed out over time. So like if I was doing inventory every month and using weighted average, which I can never do in my restaurants, it would just take us 3 days to do inventory. But if we were, it would smooth out price changes and price fluctuations, which are something restaurants have to deal with. Okay, we talked about the LIFO conformity rule. All right, this next one's very confusing for students, but it's really not if you think about it. All right, and if you follow the rules, if you do the bookmarking of the text, like I've been telling you all semester, you'll know where to go. As an example, if you just hit that mental roadblock and work in the problem. So lower of cost or market is what you have to do if something goes down in value. You have to change your inventory. This is mainly done with big ticket items. All right. We're not worried about a case of lettuce going down in value from week to week, but we are worried that if we bring in a line of motorcycles and they come out with a better version and that knocks the price down 20%, you got to change your inventory. So you only have to report the market cost when the market is lower. If it goes up, let's say, well, it's hard to find something that would apply to this. This is, not real accurate, but let's say Dell comes out with a particular computer, and for whatever reason, it's hard to get. Well, I can think of it with sneakers too. This could be the case with sneakers. So this computer is hard to get. Supply and demand has driven the price up 20%. Then you don't have to adjust your inventory. All right. If you got these computers there and you bought them at the original cost, you don't have to make any changes to your inventory. All right. Now, if in fact you bought a particular set of computers, you bought like, I don't know, 25 Dell laptops with the latest i7 chip in it, and you did it like a week before the Intel came out with a new chip and Dell came and upgraded their line. So all of a sudden these computers that you bought at say $1,000 a piece, now they're only worth wholesale $800 a piece. Now you've got to apply the lower of cost or market concept to that. And well, we'll see what it's like in the example. You can apply this can be applied in several different ways. First, you can apply it to each individual item. Obviously, we're talking big ticket items if that's the case. You can do it to an entire category of assets. So what's a category of assets? Well, if you're selling computers, all the i7 computers. Because even though some of those i7s might not go down in price, you can probably figure pretty closely what the impact is going to be to that particular line of computers, with the i7 processor. And then finally, you can apply to your entire inventory. So if you see a price drop in the i7 from $1,000 per machine down to 800, you can calculate what that is and just knock that much money off of your entire inventory. That includes all your computers and cell phones and tablets. So you do have flexibility in how you can go about doing this. So here's the example. This is 5.9 in your books. I guess we're looking at motorcycles. That's the only thing I can figure on this. I don't know what the price of motorcycles are, but just for argument's sake, we're going to call these motorcycles. So you have the Roadster, which you have 20 units, and the cost originally was $8,500, but the market has dropped to $7,000 per unit. So your total cost is $170,000 when you first bought the 20. But if you apply how the market has dropped for these 20 machines, you multiply 20 times 7,000, which is the new market price, then that only comes to 140,000. The Sprint, however, you have 10 in inventory and you paid 5,000 for it, and the market went up to 6,000. So if you had to, let's say, at a fire, you had to replace these bikes, you'd be spending 6,000 per bike, not 5,000. That means your total cost when you first bought them was 50,000, but the market has driven it up to 60,000. And so so let's look at this: lower of cost or market. What's lower here for the Sprint? Well, what's lower for the Sprint is the cost. All right. So we can eliminate market. It's lower of cost or market. And because the market went up, we're going to keep that inventory at $50,000. But if we go up to Roadster, all right, our total cost was $170,000. And then we have a market value of 140. So we got to mark that inventory down to 140,000. And if you look at the journal entry right below it, we're going to debit cost of goods sold, 30,000, just like we would do if it was damaged goods. What are we going to do? Debit cost of goods sold. And then we're going to credit merchandise inventory, 30,000, to show that price reduction and bring our inventory dollars that we're carrying on the books at what it should be now that the market has dropped for the Roadster. Okay. Exhibits 5.1 and 5.11. You can read and study the charts. You can see an example of it down in your two different year 1, year 2, and year 3 income statements. By year 3, the mistake in what you did in inventory will smooth itself out. All right. Let me give you an example of mistakes in inventory. We would, in the restaurants, we took inventory every Sunday. And so we did our food costs every Sunday. And let's say a store counted their inventory, computed what their food cost was for the week. And that is taking their beginning inventory, adding in purchases, and subtracting out the inventory they just took. So what would happen is, let's say their food cost went way up because they understated their inventory, because that's going to overstate cost of goods sold, and then net income is going to go down. Well, if it wasn't that, we don't know when we get that high food cost figure from the stores where it came from. But we assume that maybe there was a mistake taking inventory. Maybe they missed a case of steaks. Maybe they missed, 30 pounds of shrimp. Maybe, who knows? So the next week we would make sure one of the district managers or myself, the director, would inventory that store with the store manager. And 9 times out of 10, we would find out there was an inventory mistake being made. Now, it didn't affect us that bad because we caught the mistake in week 2. There's 4 weeks in a month. So, if we weren't going into a new accounting month, it took care of itself before the final numbers were put together and bonuses were calculated. But where it became a problem is if they make the mistake in week 4, and sometimes it was done deliberately so that a manager would make their bonus, and we're talking about overstating any inventory, then that became a performance and possible firing issue for the manager, because if it really was bad enough and it looked like that's what they're doing, in other words, falsifying the books to make bonus. Well, so this is, again, you want to bookmark this. You're going to have some homework questions surrounding this, and you're going to have probably a quiz question or 2 around this. So make sure that you follow this through and understand what happens. You don't got to memorize it. If you bookmark this page, and you're able to go back and see what's going on with it. Okay. So our formula of the week is inventory turnover, and it's cost of goods sold divided by average inventory. What's your average inventory? It's the beginning of the period and the end of the period added together and divided by 2. Why is this important? Well, if you're carrying too much on the shelf, all right, this is not going to be a good number. You want to make sure that you keep your money in the bank and not sitting on the shelves. Now, you can make the argument, well, we don't want to run out. We might lose customers. Da, da, da. Yeah, but I can tell you from years of running restaurants that when you actually, if you are engaged in your business, how much things you're going to go through. You're going to go through 2 cases of ribeyes a week. You're going to go through 4 cases of, say, 1/3 of a pound burger patties. So, I mean, this stuff becomes, believe it or not, very predictable. So you can really tweak your inventory to get it down to where by the end of the week, your cupboard's bare, but you're not running out. Okay. The only time you really run out is you're not paying attention to your usage. And we used to not only compute what our food costs would be, but we would, at the end of the week, we would see the individual usage. Oh, we went through a case and a half of green beans. We went through 4 bags of flour. And so if you forecast your sales, say 20% higher, you just up your order by 20% right across the board. But again, the key is to keep your inventory turnover a good number. You try to keep your money in the bank and not sitting on the shelf or in the freezer. Day sales and inventory. This is how much inventory is available in terms of the number of day sales. So you're going to take your ending inventory, you're going to divide it by your cost of goods sold and multiply it times 365. Okay. Again, you don't want this to be a high number. Because the higher this number is means, again, you got too much product sitting on the shelf. And by the way, the average amount of day sales and inventory for a supermarket, believe it or not, is 3 days. How about that? You wouldn't notice it to see all those shelves full in some of these grocery stores. And the shipping crisis that we are going through, that's really showing it because of all the bare shelves. This is something to look at, 5.15, if you're having trouble understanding the analysis part of this. You have a difference here between Costco and Walmart. And that's the end of the chapter. Now I'm going to take you in real quick to McGraw Hill. So bear with me. I have to log in. And I'm going to show you how these problems are set up in your homework. Let's see, I'll use W01. I don't know specifically where these are at, so bear with me as I scroll through. I think they start with number 8. No. Yeah, here we go. All right, so this is exercise 5.3. And as you can see, it's giving you the same transactions. See up at the top, January 1st, beginning inventory, January 10th, sales. Okay, so you know what you sold. And then a purchase on January 20th, January 25th, sales, and then January 30th, purchase. And you're going to have to calculate the ending inventory and the cost of goods sold. All right. Now, what they've done is they've kind of combined the stuff. So the only time in specific identification, you only have to worry about beginning inventory and the purchases. All right. Under weighted average, now you can see it's expanded somewhat. So now you have January 1st, you start off with 200 units at $12.50. January 10th, and by the way, these numbers are going to all be different for you. All right. This is because they're on an algorithm. January 10th, you're going to have to calculate your cost of goods sold based on your ending inventory. And this is, by the way, weighted average. So you sold 160 at $12.50 each for you. So your cost of goods sold is $2,000. Now I'm looking here and seeing that these are pre-calculated for you. So you don't have to worry about making a multiplication error. And then, but here's where you're going to have a change. Now, January 20th, all right, let's see, you had a purchase, right? January 20th, a purchase, 130 units at $11.50. And so you're going to have to break out. You're carrying 40 at $12.50. Multiply that out. That's $500. You brought in 130 at $11.50. That's $14.95. And then you got to add these together. So now you got 170 at $11.74. Make sure you round right. I think they give you a 0.01 error rate. So if you get it wrong when you check your work, just go like up 2 cents or down 2 cents, depending on what it needs to be. And that's showing an ending inventory of $19.95. You have a sale on the 25th. So you got right here, the $11.74 is your new cost per whatever it is you're selling. So 140 at $11.74, your cost of goods sold is going to be $16.43.60. Again, these are going to multiply out for you as long as you get the right quantity and the right unit cost. All right. And then you can see here on January 30th, you got in 300 at 11. So you've got to recalculate again your weighted cost average so that you can come up with an accurate ending inventory. So that's what this is what it's going to look like. Again, a lot of the work's going to be done for you, but you still got to be, methodical. And even, with it being laid out this way, again, I'll still get students that'll jump down here. They'll want to do their purchases first and then put in all of their sales. And it's like, you can't do that with weighted cost average. You have to do it one day at a time. Otherwise, you're going to mess up your unit cost. This is what FIFO looks like. And this is what LIFO looks like. So the chart's made out for you. There's, I think, minimal computations you're going to have to make. So it should be pretty straightforward for you. But if you get stuck on something, again, don't hesitate to reach out to me. All right. Let me see. Are there any questions that you'll have before I end this session? Take yourself off mute if you have a question. Okay, if not, for those that are viewing this later on that need to do this, well, even you guys have to do the survey, right? So what will be the phrase that pays? I guess what I'm going to do, I have to start figuring this out ahead of time, writing down, because I just get this mental block at this point. So just put in that FIFO is the most commonly used way of determining inventory, which it is. All right. So that's all you have to say in the survey. Just say, after viewing the video, FIFO was the most commonly used inventory method. Okay. You don't, I mean, feel free to get a hold of me. And we'll text you no later than 8 hours. That's about the average I've been running. Okay. All right. Have a good week. And well, we'll be talking again before the test. We'll have a study session night before the test is due. But just remember that your next unit test is due this coming Monday. I'm sorry, not this coming Monday. It's coming up on the 25th, I think. Let's see. Hold on a second. And no, not the 25th. It's due on the 28th. So, you know, make sure you're ready for that. And if you have any questions or anything, just give me a holler. Have a good week. Good luck on their homework, quizzes, and tests.